Investing in the stock market long term has been a proven strategy for generational wealth expansion. This, however, is quite a challenge because of the myriad of stocks to choose from even in the US stock market alone. The NYSE trades around 1.5 billion shares each day of around 2,800 companies. That is why we're here to help you narrow these choices down and look for the best value stocks we can find out there. Value stocks, as Investopedia puts it, are shares of a company that appear to trade at a lower price relative to its fundamentals, such as dividends, earnings, or sales, making it appealing to value investors. Stocks whose earnings are huge relative to how the stock market values them. We do tons of research about the stock market, and our goal is to help you on your journey to financial freedom so you can live life on your own terms. That being said, we're here to bring you the 5 top stocks to buy right now. If you like this video, make sure to destroy the like and subscribe buttons so you won't miss any of our future content. Make sure to stay till the end as our last stock pick is our favorite, and we think you'll like it too. Now let's get right into the video. First off, we have Wells Fargo & Company. Wells Fargo is one of the world's largest and most valuable banking firms. It provides services for investment and retirement, loans and credit, insurance, wealth management, online and mobile banking, and home mortgages. In the U.S., Wells Fargo Bank offers services to institutional, retail, and commercial clients. Since its founding in 1852, Wells Fargo has operated out of almost 7,000 offices throughout more than 30 countries, offering banking, investments, mortgages, and commercial financing services. With the help of its 244,000 employees, Wells Fargo invests its close to $2 trillion worth of assets to generate around $74 billion in revenue each year. Through its extensive network of services, the bank has relationships with 1/3 of American consumers. Prior to the COVID crash of 2020, Wells Fargo's stock was trading around $54 a share. This quickly tanked to $25 a share in March 2020 due to the market's reaction to the global lockdowns and bottomed only 8 months after. Though it took some time before Wells Fargo's stock recovered, it briefly surpassed its pre-pandemic highs in February of 2022, yet is now trading at a discount in the middle of the current market downturn. Recession-ready bank stocks can rally 50% next year, a Wells Fargo analyst asserts. It's about to be showtime for U.S. bank stocks, with the group likely to surge by 50% next year even as the economy falls into recession. A mild recession could give banks their best year in nearly 3 decades as higher interest rates will bolster profits. What's more, lenders face lower credit risks in the wake of reforms introduced following the 2008 financial crisis. Banks should perform better in an upcoming recession than for any other in modern history. Mayo, who has spent more than 30 years tracking banks, wrote in a note to clients, "Banks have prepared for this moment for over a decade." In light of rumors that the Federal Reserve would slow the pace of rate increases next year, which has generated discussion about whether growth stocks will once again be popular, Wells Fargo's most favorable views on banks may also bring some relief to value investors. According to the seasoned Wells Fargo analyst, bank earnings will increase twice as fast as the overall market, while trading at a price-to-earnings ratio that is a third lower than it has historically been. Looking into Wells Fargo's numbers, its revenue has tightened from $85 billion in 2012 to $78 billion in 2021 due to a couple bad years, largely due to bad PR, yet it still averaged $83 billion over the course of 10 years. What's interesting though is when you look into their net profit margins. Banks typically have fat margins, and Wells is no exemption. Wells Fargo has booked an average revenue of 23.7% over the past 10 years. From 22.3% in 2012 to 27.5% in 2022. Its return on invested capital has averaged 5.1% over the same period, from 6.4% in 2012 to 5.6% in 2022. At its present share price of $41 a share and conservative earnings per share predictions of 5% annually, our model projects that Wells Fargo stock will have annual returns of 10.7% over the next 5 years. Next up, we have Pfizer Inc., PFE. Pfizer Inc. is a huge, internationally recognized biopharmaceutical firm. It is involved in the worldwide discovery, development, production, marketing, sales, and distribution of biopharmaceutical goods. The business advances wealth, prevention, treatments, and cures that take on the most feared diseases in both developed and emerging countries. The business's headquarters are in New York, and it was established in 1849 by Charles Pfizer Sr. and Charles Erhardt. The stock peaked at $38.66 a share at the beginning of 2020, yet crashed simultaneously with other global stocks when the pandemic hit. It plummeted roughly 30% from its peak and has steadily recovered since then. Peaking at $61 a share at the start of 2022, the stock is down roughly by 24% year to date. Pfizer disclosed solid fresh data on its maternal respiratory syncytial virus study in addition to earnings that exceeded Wall Street expectations. By the end of the year, the business hopes to submit the injection for Food and Drug Administration approval. This puts Pfizer on track to conceivably release an RSV vaccine for senior citizens next fall. In late 2023 or early 2024, it might release one for expectant mothers. RSV is a widespread virus that typically only produces a mild illness in young infants and adults, but it can also have major side effects. Only Pfizer seems to be going forward with an RSV vaccine for expecting moms that are meant to protect their newborns, while a long list of other companies is working on RSV vaccines for older adults. Looking into the numbers over the past 10 years, the company's revenue has grown from $59 billion to $81 billion with a 46.2% operating margin. Moreover, its return on capital invested has averaged 11.4% over the same period. Our model suggests that the stock is still relatively undervalued compared to the overall market, with a P/E ratio of just 8.96 times its earnings. This biopharma company's future post-pandemic is still bright, given that the world has learned so much and has developed at an unforeseen pace thanks to the urgency that this pandemic brings. Coming up next is JP Morgan Chase & Co., JPM. Bank stocks typically benefit from a rising rate environment because the higher the benchmark rate is, the higher the interest rates banks charge on their current loans, mortgages, credit cards, and the like. With this in mind, it's best to look into one of the titans of the banking industry. JP Morgan Chase & Co. is a Delaware-incorporated New York City-based international investment bank and financial services holding corporation. With total assets of $3.954 trillion as of 2022, JP Morgan Chase is the largest bank in the country, the largest bank globally by market capitalization, and the sixth largest bank globally in terms of total assets. In addition, JP Morgan Chase is included as the 24th largest American firm by total revenue on the Fortune 500 list. Along with Bank of America, Citigroup, and Wells Fargo, it is one of the big four banks in the United States. JP Morgan Chase is regarded as a custodian bank and a universal bank. The divisions of investment banking, asset management, private banking, wealth management, commercial banking, and treasury services all operate under the JP Morgan name. At the start of the COVID-19 outbreak back in Q1 of 2020, JP Morgan Chase & Co. JPM stock price tanked by roughly 45% from a peak of $140 a share at the beginning of 2020 down to $77.52 a share in March of the same year. While this presented a window of opportunity to accumulate JPM stock at a bargain, the stock's recent rally has invalidated its year-long downtrend and is poised to reach higher levels. The acquisition front has seen activity. The firm recently acquired Global Shares, a leading cloud-based provider of share plan management software, for an undisclosed sum. By closing that agreement, JP Morgan's wealth management business will have a new customer acquisition avenue and will be able to offer a wider range of services to corporate clients. Additionally, JP Morgan has agreed to buy Renovite Technologies, a well-known provider of cloud-native payment technology. According to the company's leadership, this change will increase the company's merchant purchasing capabilities' flexibility on a global scale. Based on the numbers we've gathered, JPM has grown its revenues from $92 billion in 2012 to $131 billion in 2021. Its operating margin has significantly grown from 23.2% in 2012 to 36.9% in 2021. That's an average of 27.5% over the past 10 years. What's more, the return on equity has averaged 11.2% over the same period. Everything looks good when we look at the stock valuation for JP Morgan. At its present share price and conservative earnings per share predictions of 4% annually, our model projects that JPM stock will have annual returns of 14.5% over the next 5 years. Next, we have AT&T. AT&T offers media, technology, and telecommunications services. The company provides wholesale services, telecommunications equipment, managed networking, local and long-distance telephone services, data broadband and internet services, and wireless communications. Additionally, AT&T distributes feature films, television, video games, and material in both physical and digital formats. It offers residential consumers, entertainment, and advertising services to both small and large businesses. At the start of the COVID-19 outbreak back in Q1 of 2020, AT&T's stock price plummeted by roughly 32% from a range of $28 to $30 a share from September 2019 through March 2020, down to $19.77 a share. While this presented a window of opportunity to accumulate AT&T at a discounted price point, today's market downturn has presented us with an even better opportunity. With the reduction of 5G capital spending in the sector, AT&T could become a huge cash flow machine again. AT&T saw stronger than expected Q3 customer gains in postpaid phone subscribers at 708K and fiber subscribers at 338K, whereas Verizon only booked an additional 8,000 postpaid phone subscribers for the same quarter. AT&T's growth continues as it booked 3.6 million postpaid phone subscribers and 1.2 million fiber subscribers in the last year alone. Based on the data we've gathered, AT&T's revenue has grown from $127 billion in 2012 to a whopping $169 billion in 2021. That's an average of $155.2 billion over the past 10 years. Its operating margin has averaged 11.9% from 11% in 2012 to 13% in 2021, and its return on invested capital has averaged 8.6% over the past 10 years. Based on our conservative estimates, AT&T still has a lot of room to grow, and based on our model, the stock is estimated to make an average return of 18.1% annually over the next 5 years when you include the dividend returns as well as the growth in the share price. If you're looking for some of the most solid stocks with high dividend yields, AT&T might just be one of your top picks. Last but not the least, we have FedEx. FedEx Corp is a transportation and shipping company. It was founded in 1971. The organization provides a range of services, including as business services, e-commerce, and transportation. FedEx Express, FedEx Ground, FedEx Freight, and FedEx Services are its 4 main operating segments. FedEx offers freight shipment as well as domestic and international package delivery. Additionally, it offers services for billing, collection, customer service, billing, marketing, information technology, communications, and sales. At the beginning of 2020, before COVID happened, FedEx's stock was trading at around $160 a share. This sharply fell 44% down to around $90 a share when global lockdowns dominated the headlines. However, due to government stimulus, we've seen the stock soar from $90 to $316 in a matter of 14 months. The stock, however, as with other stocks, is retracting back to $170 level, which we believe is a good entry point for long-term investors like you and me. Just recently, FedEx expanded its electric cart routes in New York City. FedEx and BrightDrop revealed a massive electric van deployment in June, distributing the first 150 Zevo 600s to various locations throughout Southern California. This would constitute one of the largest distributions of electric vans to date. We're bringing entirely new ways of doing business to the delivery market by providing a holistic, one-stop shop portfolio of first-to-last-mile solutions that allow fleet customers to do their jobs more efficiently while helping alleviate strain on the workforce and the environment, said Rashad Youssef, Chief Product Officer at BrightDrop. Part of that includes building a software program that leverages data and simulation to demonstrate how new technologies can work for them. This integration will take our software capabilities to new heights while continuing to deliver as promised for our customers. Looking into FedEx's numbers, its revenue has grown from $44 billion in 2013 to $94 billion in 2022. That's an average of $63 billion in just within a decade. Its operating margin has averaged 7% from 11.5% in 2013 to 7% in 2022. Its return on invested capital has averaged 8.8% over the same period, from 14.8% in 2013 to 8.5% in 2022. At its present share price of $170 and conservative earnings per share predictions of 6% annually, our model projects that FedEx stock will have annual returns of 10.5% over the next 5 years. There you have it, folks. Those are our top 5 value stock picks for the week. Comment down below your favorite stock pick, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing day ahead.